Feeling that knot in the stomach about buying right before a drop is normal, but that fear is a symptom, not the root problem, and there's a simple habit that removes the guesswork without asking for perfect timing. The goal is to replace one-off decisions with a fixed, automated contribution schedule, so the market's noise stops dictating your actions and your discipline compounds over time. When contributions run on rails, your attention shifts from when to buy to how long to stay invested, which is the real lever that lets earnings earn more earnings. In the North American context, this habit plugs neatly into the tools you already have: payroll deferrals into a 401k or Roth 401k, automated deposits into an IRA or Roth IRA, and recurring buys in a brokerage account, so the process becomes as routine as payday itself. Everything here builds on the snowball from earlier videos. Reinvestment plus time grows the base that does the heavy lifting, but the snowball only rolls if you keep nudging it with steady contributions. Dollar cost averaging is that nudge on a schedule, ensuring more of your months count toward compounding rather than being lost to hesitation and headlines. The point is not to predict short-term moves, it's to guarantee long-term participation, because participation is the toll for compounding's most valuable miles. Dollar cost averaging, or DCA, means investing a fixed dollar amount at regular intervals regardless of price, which naturally buys more shares when prices are lower and fewer when they're higher. It's primarily a behavioral system that converts volatility from something to fear into a mechanism that accumulates ownership over time without constant decision-making. Technically, this smooths your average cost along a bumpy path and helps you stay invested through swings that might otherwise knock you off course. Think of DCA as turning price turbulence into scheduled share pickups, while your reinvested dividends and interest add even more fuel between those deposits. Perfect timing is appealing but impractical because short-term swings are noisy, and the difference between a great entry and a bad entry often only becomes clear in hindsight. Waiting for certainty tends to morph into months out of the market, and those are months you can't get back for compounding, which depends on time in, not moments picked. A fixed contribution schedule dodges this trap by removing the permission structure for second-guessing and replacing it with a rule you follow through cycles. Aligning contributions to paychecks is the easiest way to make the habit stick, because decisions made on payday are easier to automate and harder to skip. For many in the U.S., payroll deferrals into a 401k Roth 401k mean investing before money ever hits the checking account, which protects your plan from lifestyle creep. After capturing any employer match, adding an IRA or Roth IRA auto transfer on a fixed date extends tax advantage compounding beyond workplace limits. If you invest in a taxable brokerage, set a recurring buy that lands a day or two after the recurring transfer, so the cash is ready to deploy on schedule. Reinvesting what your holdings pay out is the second half of the habit, because idle distributions blunt the compounding you work to set up. Turn on drips, so dividends automatically purchase more shares, often fractionally, without waiting for you to log in or place an order. Where available, enable interest reinvestment for bond funds and cash sweep vehicles, so every dollar resumes work immediately instead of sitting still. This way, even months when you don't add new cash still add new shares, keeping the snowball sticky between paydays. Volatility becomes a feature, not a bug, when your amount is fixed, because a dip simply means your set dollars buy more units, and a rally just means you buy fewer. Over time, that steady cadence lowers the average cost along a jagged path, even if the end balance is ultimately driven by how long you stay invested and reinvest. This reframing matters because it changes dips from threats to avoid into inventory sales you automatically shop, which reduces regret and keeps the schedule intact. A few practical guardrails keep the habit resilient when life gets messy. Keep a modest emergency fund so a surprise bill doesn't force you to shut off contributions or sell investments at bad moments. Anchor contributions 24-48 hours after payday to prevent accidental overdrafts and to insulate the plan from end-of-month pressures. Put a quarterly reminder on the calendar to confirm deposits ran, verify drips are still active, and nudge the contribution up a notch if cash flow allows. Fees and taxes are headwinds, so choose low-cost, diversified funds to reduce the drag on compounding and prefer tax-advantaged accounts first to keep more gains in play. Traditional accounts, like 401(k) and IRAs, defer taxes so more of each year's return stays invested until withdrawal, amplifying the effect of your schedule. Roth structures trade tax now for tax-free qualified withdrawals later, which can be powerful across long horizons when paired with unwavering cadence. In taxable accounts, staying mindful of distributions and holding periods helps, but don't let tax fine-tuning derail the DCA habit that does most of the work. Sizing contributions is about consistency first and intensity second, because a contribution you can keep through rough patches beats a bigger one that collapses under stress. A simple rule is to start with an amount you won't miss, and then escalate by a percentage each year or with each raise, so the habit grows with you. If volatility makes you nervous, set the amount at a level that won't tempt you to pause during downturns, since missing months is more costly early than late. Negative compounding can sabotage everything, so handle high APR credit card balances with urgency while maintaining at least a minimal DCA to keep the investment clock running. Credit card interest is commonly calculated with a daily periodic rate applied to your average daily balance, which means the cost compounds against you frequently. The return from paying down a high APR is equal to the interest avoided, making it one of the best risk-free moves available, especially before scaling up contributions. Keep drips on for existing investments so compounding doesn't pause while you redirect extra cash flow to eliminate toxic debt. If a major disruption hits job loss, medical emergency, or similar, define in advance how you'll pause and when you'll resume so the system recovers quickly. Consider setting a minimum floor that continues even during hard times, then automatically step contributions back up as soon as the trigger conditions clear. Protecting the streak matters, because every month you keep the machine running is another period for reinvestment and another chance for time to do its work. Here's a clean setup you can copy today. Route the first dollars of each paycheck to your employer plan to capture any match. Then add a fixed monthly auto debit to an IRA or Roth IRA on a date that follows your pay cycle. In your brokerage, schedule a recurring buy the day after a recurring transfer so cash is in place and the order executes automatically. In every account, toggle on dividend and interest reinvestment so distributions buy more shares by default. Use a reputable compound interest calculator to visualize a conservative, base, and optimistic scenario to stay motivated by the long arc you're already traveling. Seen from above, this entire habit is just the snowball in motion. Your fixed contribution adds mass, reinvestment keeps that mass sticky, and time provides the slope that accelerates the roll. The real win is that a rules-based schedule trades short-term certainty, which no one can reliably have, for long-term participation, which everyone can choose to keep. When the process becomes the promise, the market's day-to-day noise fades, and the compounding you care about keeps clicking forward month after month. Next up, there's a head-to-head showdown between dollar-cost averaging and lump-sum investing, so you can see when DCA shines behaviorally and when lump-sum can win mathematically. Expect clear scenarios, timeframes, and practical decision rules you can apply to bonuses, tax refunds, or windfalls without second-guessing. Subscribe and bring a number you're likely to invest soon, and be ready to test both paths side by side so future you doesn't have to wonder which lever to pull.